visit ronblue.com. Ron Blue Trust is a trademark used by Thrivent Trust Company and Thrivent Trust Company of Tennessee Incorporated, separate affiliate entities. Now back to Talking Money.
Yes, and welcome back to Talking Money. You're listening to Mike Miller. This is Talking Money, which means we want to talk about money. We want to hear your questions, 877-235-9405. You can text a question there, or, of course, you can always call. So we want to make sure we answer your questions. If you're listening via podcast, then I would say you want to go to talkingmoneyradio.com and type in or look at the Ask Mike a Question, click on that. Or you can send an email directly to me at mike@talkingmoneyradio.com. So either way, you can get the question to us. We want to make sure you are informed and get an objective answer to whatever question you have. There's no question too stupid, no question too difficult. If I don't know the answer, I will find the answer. I've got an array of resources in our firm, as well as the local professionals that we can speak with to get the right kind of answer that you need. So we're talking about different kinds of investments last week and this week, and probably we'll continue this conversation even some next week. We talk about the different risk levels of different types of investments. I just spent right before the break talking about stocks, the different how does a stock work, and the basics of a bond. And one of the things that people, I think, are not as aware of is how a bond price can change via interest rate changes. So as my one example would be to say, all right, you buy a bond, you pay $10,000 for a bond, and you pay 3%, you get a 3% yield for that bond. So if interest rates then, and yours is let's say a 10-year bond. So in 10 years, you're going to get your $10,000 back. So if interest rates during that 10-year time period go from 3% to 2%, well, that makes your bond worth more, because somebody would like to buy your bond and earn 3% versus buying a new bond that's only paying 2%. So they're willing to pay you, and you should be wanting to get a premium for that bond. You don't want to sell it to them for what you paid for it, because then you're going to have to turn around and invest your money at the lower rate. So instead, you have a 3% bond. It's now going to be worth more. So typically, and the chart I have is using 6% as the paying interest, but the concept is the same. So if a bond, the value of a bond, when interest rates rise 1%, if it's a 5-year bond, so it has a 5-year maturity, that bond's going to go from $1,000 to $959. If interest rates go up. If interest rates go down, like my example, in a 5-year bond, it's going to go from $1,000 to $1,043, and that assumes you have 5 years left in the bond. So the closer you are to maturity, the less change there is in the current bond price, because it's going to affect a shorter period of time and it gets close to maturity. So in this case, if I have a bond that goes up to $1,043, and it's a 5-year, there's 5 years left in the bond, I know I'm going to lose that $43 over the next 5 years. All right. So because when it goes to maturity, it's going to mature at $1,000, not at $1,043. So the decision you have to make, the decision money managers have to make, is do I go ahead and sell the bond now, and do I think interest rates may change enough and that they may go back up in the next 5 years to where I can buy back in and buy at a better interest rate than what I'm selling it for? That's the game that's being played all the time. So if interest rates go down, then you're going to have your bond selling for a premium, depending on how much longer is left until that bond matures. If the bond goes up, if prices go up, interest rates go up, which they're more likely to do now since they've been down so far. And what's happened in the last year, as interest rates have gone up, that's what's happened to the price of bonds. They've gone back down. Now, in a bond fund, they typically eventually catch up because they're continually buying more bonds at the higher rate. And you might have 1 year where you actually lose some price in that bond, even lose some value in that bond, but then the next year it starts to come back. So it's rare that they have more than 1 or 2 years in a row where they actually go down. But you still get your dividend through that whole thing. So if you were not looking at your statements and didn't see the price changing, and you kept getting the same dividend, as far as you knew, the price stayed the same. The price did not change. So the value of when interest rates rise 1%, that same 5-year bond went from $1,000 to $959. So if you want to get out of that bond, because yours is paying 3% and new rates are 4%, or in this case 6% versus 7%, if you do that, then you got to take a loss to get it. So you got to decide, okay, since I got to sell my bond for lower than it's worth, but then I got to rebuy at a higher rate, will I more than make up for that? But typically the bond market prices those kind of movements in for you so that the price changes are already there. So that's how interest rates and bonds affect each other. And something I did not mention in the stock portion that I think is a good illustration. So some years ago, Dr. Rook and I were on the phone with a money manager of a firm that we were looking at adding to our portfolios. We've done a lot of the research on the number side, but we always like to talk to the money manager themselves. Who's the one pulling the trigger? Who's the one in charge of this particular investment? And so we were asking different questions.